All right, Chapter 6, dealing with inventories, which will affect the cost of sales. Can be a little confusing for students because there's different ways of calculating inventory costs. And there's 4 major ways, so let's get into that. And I do have a way to maybe simplify that for you. Determining inventory items. So merchandise inventory includes all goods that a company owns that's for sale. This doesn't include other assets like equipment or trucks or building, but this is typically what you're going to resell. And it's regardless of where those goods are located when the inventory is counted. They could be in trucks in transit, they could be in different warehouses and so forth. But we do need to include certain things that you need to pay attention to. Goods in transit includes those that are being shipped to you. Or maybe you're shipping to someone else, but you still own legal title, and the issue is legal title, which we'll get into. We have to pay attention to goods on consignment. Consignment means that you hold inventory, but you don't own it. An example would be like a thrift store is selling maybe furniture or clothing, but the other individuals own that clothing, so they're just acting as a broker. They don't actually have title here. And then we have to pay attention to any kind of inventory that's damaged or obsolete, because we are going to have to mark that down to reflect that depreciation of value on there. Let's get into goods in transit. We touched on this a little bit earlier. Let's get into specific issues here. So there's 2 points you need to consider here. FOB shipping point and FOB destination point. So it's shipping point or destination point. And what they're talking about is the identification when legal title transfers. So if it is shipping point, it is when it leaves the seller's warehouse. At this point in time, title transfers and the buyer owns it. If it's destination point, that means it has to be delivered to the buyer and go into their warehouse before title transfers. And so while it's in transit, who owns this? Well, again, it depends on if it's shipping point or destination, and these 2 points are negotiated between buyer and seller. But if it's shipping point, then the buyer owns it while it's in transit. They're the ones who are going to have to cover for the insurance in case something happens if that merchandise is being shipped. Whereas if it's destination point, then the seller still owns that, and he's going to pay for the insurance and transportation costs. So this becomes an important component when evaluating your inventory costs. Goods on consignment, again, there's a consignee, consignor. A classic example is maybe a thrift store, where that thrift store does not actually own the merchandise, it's just acting as a broker. You do not include that in your inventory count, again, because you don't have legal title for that. Goods that are damaged or obsolete. You don't count these in the inventory as if they can be sold at the face value that you expect it to. Your costs have to be reduced to the net realizable value. This net realizable value is management's best estimate. It's not an exact science, but you do have to mark it down so you don't overstate your inventory value. So determining your inventory costs, you need to include all expenditures that was necessary to bring the item to a sellable condition as well as location. So that includes obviously your invoice cost for the product, but there could be a minus or plus any discounts or allowances, maybe import duties plus freight plus storage plus maybe insurance. So all these costs are included in your inventory cost, not just what you actually paid for the product. There could be a variety of other fees that go into that affects that. And understand that this affects the buyer, not necessarily a seller. We'll get into some differences here. So internal controls is something you're going to get into in some later chapters. It's actually very important. And internal controls is how a company manages its accounting systems and how they protect certain assets. So from an inventory standpoint, it means taking also a physical count. And no matter which inventory you're using, whether it be perpetual or physical, you still have to at least count physically your inventory at least once a year. Okay? Some good other internal controls that help with managing your business is using pre-numbered inventory tickets. Maybe a second count is taken. Managers confirm all items. There's a variety of things. You might use certain locks, certain passwords to get to this inventory. It's one thing if your inventory is a lump of coal. It's another thing if it's a basket of diamonds. As you can tell, the different value of that inventory is going to affect how you manage that inventory. So inventory under a costing under a perpetual system, and remember, a perpetual system is something that the computer does ongoingly as you bring merchandise inventory in or when you sell it. And we're going to do something that requires the matching. We have to match the cost with the sales. So you're going to have two different components. You're going to have a balance sheet component and an income statement component. Inventory cost flow assumptions. Management decisions for inventory include items in their inventory and their costs. So you're going to gather all your costs from various things. It could be insurance, transportation, storage, that's included in that inventory. And then you're going to choose what method are you going to use to value this inventory. And there are four methods: specific identification, FIFO, which stands for first in, first out, LIFO, which stands for last in, first out, or a weighted average. And is your system a perpetual or periodic? Periodic is physical, where you're actually going out and counting at a certain time. Here, a computer is maintaining your balance on an ongoing basis. And then another component is using market values or some other estimates. And here we have a chart of how many companies are using different methods and you can see FIFO is used 50% of the time. LIFO is maybe 1/4 weighted average, and other, typically that will be the specific identification, and we'll get into all four of those here in a minute. Inventory cost flow assumptions. First in, first out, known as FIFO. It assumed cost flow in the order that it was actually incurred. This sort of maybe matches the physical flow. Last in, first out assumes cost flow in the reversed order. So what it's saying here is, on the first in, first out, the inventory that you bought first, you're going to sell first. Whereas in LIFO, it's the product that you brought in last, you're going to sell first. This can start getting you confused, and I have a way to simplify it for you. Weighted averages, you're going to average all your cost flows and sort of give it an aggregate price value. An example would be like in fluids, like maybe your beer or petroleum or soup. You're not going to really identify each value for each can of soup. You're going to give it a generic value. Here's another confusing component. Cost flow versus physical flow. There's no legal accounting requirement that the cost flow assumption be consistent with the physical movement of goods. What they're saying here is that management has a choice of what inventory system they use, and it does not have to match how they actually physically move their product. And more often than not, their choices will be dependent on what gives them the best benefit from a taxing standpoint. And we'll get into that in a little bit. But it does not have to match the physical flow. Here's an inventory costing illustration on slide 12. You have a beginning inventory, and then you made some purchases, and you can tell you're buying different units at different prices, which affects the value. You made some sales and so forth, and then you have your unit count. Well, as you can see, determining on your beginning, your purchases, and when you sold stuff is going to change certain values depending on how you allocate these costs. So let's get into the specific methods. The first and the easiest maybe is the specific identification. This is usually where you're dealing with a complex product that has maybe been assembled and you can identify each product. Classic case would be an automobile. Each automobile has a specific identification called the VIN number. It's on your windshield and it's used for identification. These manufacturers or resellers will track their inventory by each individual car. They don't blend this price in. Every car will have a specific cost depending on what attributes or what components are added in that car. So the specific identification is used for typically very high dollar value, like airplanes and boats and cars. But things can also be computer chips and so forth. But it's with merchandise that can be identified individually, and we track those specifically. And again, we'll have an income statement, cost of goods sold versus a balance sheet. And what they're saying with the cost of goods sold is you take your beginning balance, you add all your purchases, then how much did you sell? And of that you sell, what was the cost of that amount that you sold? And that will change over time, and we'll get into it. And then your remaining balance stays in the inventory. And what number or price do you associate with that? Again, depending on what method you're using. Specific identification, here are the entries to record purchases and sales. So let's get into this. A, your buying inventory. So you have merchandise inventory, you're increasing it, hence a debit, and you're increasing your accounts payable. And so you have to track a few things. A, the date when this merchandise was legally purchased, and how much for, and maybe how much inventory. And that could be in the notes and so forth. So you had 3 purchases. Now you've made some sales, and you have sales of accounts. You've made $2,600 on credit, so you do that. But now you have to calculate or journalize the cost of goods sold. How much of this $2,600 was your merchandise cost? And depending on the method, it can change based on the method chosen. But you have to reduce your inventory count and then charge it to a cost of goods sold. So this becomes a calculated amount, and we'll get into that in a minute. First in, first out. Maybe I should stop here so we can start another section. This section is going to take a while, so this will be the end of part 1, and then I'll start here.